Hey everyone, welcome back to my channel once again. Today's topic would be a stock which I recently added to my portfolio last week on Friday, and I will walk you through the detailed analysis on this stock and how one factor is never a deciding factor for me or for any investor out there who is going deeper into analysis. And in this example, that one factor would be price to earnings ratio. So without further ado, let's dive into it.
So the company which we are going to talk about today is a German company, Varta AG. This is the official website of Varta AG. Now, what is this company all about? So Varta AG is a group. That means it operates through its subsidiaries, which are Varta Microbattery GmbH and Varta Storage GmbH. So what they are dealing with, so these are the business segments which are dealing with microbatteries and power and energy. So Vata Microbattery is dealing with microbatteries and Vata Storage GmbH is dealing with power and energy sector. And Vata Microbattery GmbH is already an innovation leader in the field of microbatteries. And just to clarify this, that Vata's most of the revenue is coming from this business, microbatteries. So they are the market leaders of lithium for lithium batteries as well. So just to show you guys, so these are some of the solutions which Vata is providing at the moment: micro batteries and solutions, and household batteries, which consist of further healthcare, entertainment solutions, consumer batteries, and energy and storage. So this segment is the Vata Micro Battery GmbH. In Germany, it's GmbH, and I'm saying GmbH because in German we call it as GmbH, not GmbH. So, and the other sector is this one right here, Vata Storage GmbH. And these are some of the applications where the micro batteries are used, especially the hearing aids. Vata has a really good business in medical industry and especially for hearing aids. And this is the other segment, power and energy. And this is working the same way like solar panels. So that means the energy is collected throughout the day and then it is converted to electricity or power for your home or even commercial factories and commercial places. So energy on demand for private households and commercial applications. So like I said, it is the market leader for lithium-ion batteries in wearable segments and especially in the hearables segment. And it has 5 production manufacturing facilities in Europe, Asia, as well as in Central Asia. Okay, so that was a short introduction about the company which we are talking about today, Varta AG. It belongs to electrical energy sector. So let's have a quick look at the summary of the Varta AG at Yahoo Finance. So the market capital is currently sitting at 3.634 billion and the 52-week range is from 42 euros to the highest peak 128 euros. So this is one of the other reasons why I chose Varta AG. So I bought this company on last Thursday at around 75 euros, and that was still at around 50% discount. And yes, guys, I can see that the PE ratio is quite high, but we will get onto this later in this video. So when I bought this company, it was still high. It was around 65. The PE ratio was around 65. So yes, I will clarify this later in the video why I still chose this. So the other thing which I really like about this company and which I usually check is the financials. So if you see here, the financial chart annually, it is growing like really steadily. So you see the revenue is growing steadily, but the other thing which is really attractive about this company is that the earnings is almost double every year. So if you see here, the earnings are increasing by 90% every year. So this is one of the best things what I really liked about this company, Varta AG. And now let's quickly dive into the financials. So we go to the financials, and as usual we will check the income statement. I will not go into the details, so we will just quickly check the numbers in order not to make this video too long. So the latest financial report says the total revenue is around 487 million euros. Gross profit is around 314 million euros. So as you see here, this is what you should always check, the trend. The total revenue is increasing, but also the gross profit is steadily increasing. Now the operating expenses is around 216 euros and operating income is around 97 million euros. So yes, the total operating expenses are increasing, but also the operating income is increasing. So if you see here that the operating income was almost doubled from 2018 to 2019, which is quite a good thing, which means they are really dealing with their operating costs quite nicely. The next is the net income. The net income is positive. That means the company is making profit. And let's move on to the balance sheet. So let's quickly check the balance sheet. So the first number which is worth checking here, it's the total current assets, which is actually really steadily increasing over the years. And the next number which is to be checked is the total non-current assets, which gives us a total of 668 million euros. So total current assets plus total non-current assets gives us a number of total assets. So the total non-current assets means the assets which they can not liquidify in the coming 12 months. These are long-term assets. So like property or plant equipment, that means they are not planning to liquidify this in the coming 12 months. Okay, and then we move on to the liabilities. So we check here the liabilities. So the current liabilities, that means the company which the company owes in the coming 12 months is around 165 million euros, and the total liabilities is around 254 million euros. Now guys, this is what I call a really strong balance sheet. What I mean by this is that if now at this moment of time, if the company's revenue stops completely, that means there is no income and there is no profit, and it has to pay its current liabilities, which is 165, that means the liabilities which the company owes in the coming 12 months, it can pay off not just this amount, it can pay off actually all its liabilities, short term and long term, by just liquidifying its current assets. This is huge. That means they won't even touch the long-term assets, and they can pay off all its liabilities with just the current assets, and still they will be left with some assets. And this is, according to me, is a really stable company, and also means that this company is not going out of business anytime soon. So the other numbers which are worth checking right here for this company especially is stockholders equity, further which is further divided into common stock and retained earnings. So common stock means that they have been investing money in stock repurchase, and actually I'm not a big fan of this practice, but for such a company with strong balance sheet, this is quite justified. And also retained earnings, now this is a bonus for me. That means they have been paying their dividends quite steadily, as you can see here. So this is the amount of the money which is left off after paying the dividends. So this comes with a bonus. To be honest, I don't buy a company based on its dividend yield. I never do that. But if it's a good company with strong balance sheet, then it's a bonus for me. So the next number which is worth checking on the balance sheet is the stockholders equity. And as we saw that the current assets are really increasing for this company year by year. And that also means that the stockholders equity must be increasing. This number right here is actually balancing out the whole balance sheet. So it simply means the total assets minus the total liabilities, and that means the company's assets, if this number is increasing, that means the company's assets is increasing as compared to its liabilities. So this number right here should always be increasing, and you must definitely check that. And it's increasing really nicely, as you can see. So this is quite good for this company. So now let's go on to the cash flow statement. Okay, so the first number which needs to be checked right here is the net cash provided by the operating activities, and this number should be increasing first of all, and should be of course positive, because this means that the operations are actually good and the actual operations are making profit. So the next is the cash flow from investing activities, and if you see here, this number is in negative. Okay, we don't have the expenses here, but let's see for 2019 quarter 4. And if you see this number negative, this doesn't mean that this is a bad thing. That means they are investing the money. If you see here, they are investing the money in, for example, in property or plants. So this means that they are investing the money in their own company. So this is good, because this will actually lead to increase in the number of assets. Okay, so the last thing which we need to check is the net free cash flow. So free cash flow in the trailing 12-month period is around 24 million euros, which is good. That means they can do anything, whatever they want with this cash. Okay, so after checking all the numbers from the balance sheet, I have summarized all the margins and the numbers which I usually consider. So let's quickly check all of them. So gross margin percentage is around 67%, and guys, this is really high. An average good gross margin is considered to be around 30%, and this is 67%, which is amazing. Now operating margin percentage 20% is also really good. That means the company is able to save around 20% of the profit after all its operating expenses. Now EBITDA margin we have already discussed in our previous video. Average EBITDA margin in electrical industry is around 20 to 25%, and you can see it's 184%. Now why it's so high? It's because of its earnings. So the earnings have almost doubled every year, and also in 2019 it has doubled, and it's been around 99 to 98 to 99%, which you will also see further in the video. So that's the reason why the EBITDA margin, earnings before income tax, depreciation and amortization, is really high, and that's why I like this company. Current ratio is around 2.3. Now this means it's the ratio of total assets by total liabilities. That means even if the revenue of the company is stopped completely, the company can pay all of its liabilities 2 times over. Book value, so just current ratio, you should always see that the current ratio must be higher than 1. 2.3 is amazing, so that means this company is not going anywhere anytime soon. Book value is positive, and total stockholder equity is also really high. The board number shows almost the same thing, that the rate of the assets of this company is increasing higher as compared to the rate of its liabilities. Now, return on investment capital means that the company invested some money and on capital, or invested money in its own business, and were able to generate profit of around 21.25%. Anything above 10% is considered really good for a company. That means the company knows how to invest money to generate profit. Price to earnings ratio is 71.4, and we will come soon on this number, why it's so high and why I still consider this stock, though the price to earnings ratio is really high. Now, typically the price to earnings ratio which I consider, or I say it's good to invest in a company, is around 20. But this is a perfect example to show you guys that price to earnings ratio, or any one number or any one ratio, is never enough, or never should be the only number or ratio for you to decide to invest in the company or not, or for any smart investor. So the discount means that how at what discount I actually bought this company, so discount on the stock price as compared to its peak value. Okay, so now let's check the numbers game. So let's see why I actually invested in this company. So yes, the balance sheet was quite strong enough, and that was just the fundamental analysis. But now we will actually see that despite of this company having a high PE ratio, which is usually considered by many investors, but it also means if it's really high, that means the company is supposed to be overvalued, because the price as respect to its earnings is quite high. But still, why I considered this company, and we will see it right here. So I purchased, like I said before, I purchased this company at last Friday, and it was sitting at 75 euros at that time, and the float value was 16.48 million. Now, what float value actually is, it is just the outstanding shares outside in the market. Float value you can easily see from statistics. Go to statistics and just scroll down, and you will see it right here. This is the float value, which is 16.48 million, and that's where I took this value from. So that means we can calculate the market cap at which I actually purchased this share, which is simply the purchase price multiplied by the float value, and this gives me a market cap of 1.23 billion euros. Now, the average PE ratio for electrical industry is 16.9, and this value I have got from Yahoo Finance, and you see that 16.9 is the average PE ratio for the electrical industry. So I took this PE ratio because, like I said, this PE ratio is considerably good and believable according to me. So that's what I do when the PE ratio for any company is quite high, and to check if that PE ratio is actually justified. So in this case, I took a believable PE ratio with which is 16.9, which is below 20 or 25, which is quite good PE ratio for any industry. And this gives me a reflected earnings. Reflected earnings is just market capitalization, which I got from this previous calculation divided by the average PE ratio, and this gives me a reflected future earnings of 73 million euros. Now, what this means? This simply means that when I bought this company at 75 euros at a market cap of 1.23 billion euros, I considered that this company will surely in future make above or somewhere around 73 million euros in earnings. And if this company is successful in making any figure around 73 million or above then my purchase price is justified and I will surely make a profit. This is one of the ways how I decide my stock, especially for example in this case when the PE ratio was higher. Now, why I believe that this reflected earnings will be crossed for sure. So let's check that out. So as you can see here, I took this value from here. 50.39 million earnings was the earnings in 2019. And if you see here, 2018 was 25.26 and 2017 was 13.27 million euros. Now, what this means? This means that the earnings has been increasing steadily. For example, from 2016 to 2017, it was around 40% or 50% increase, and from 2017 to 2018 it was around 90%, and 2018 to 2019 it was an increase of 98%. So this means if the revenue keeps increasing in this manner, the earnings is probably going to increase in 2020 as well, around 90% or 95% or even more. So let's check the revenue, what the revenue would look like in 2020 for Varta. So as you saw that previously the earnings had been increasing steadily by 90% or so, minimum 90%. So that earnings are justified when of course the revenue is also increasing by an equivalent amount of percent or somewhere same as in the history or the past years. So let's check it out. And as you can see here, the group revenue for Q1 2020 was 198.5 million euros for Wata. So if we calculate this, so let's say 198.5 million euros for 4 quarters gives us a revenue of 794 for the whole year 2020 for Wata. But okay, so let's say this is overestimated because in Q2 most of the companies in Germany were closed, and Vata was, let's say Vata was also closed and it could not produce in 2 months of Q2, and it could not make as much as profit as Q1. So in this case, what we will do, we will take, let's say, the minimum revenue for Q1 in 2019. So from annually, I switched to quarterly. So here we will see that these are the quarterly revenue of year 2019. And let's take the minimum revenue. Now, this is also really underestimated, but I always choose a stock with the worst case scenario. So let's say this is what it will make in Q2. 76.97 million euros, and let's say in Q3 it also didn't do well. It took some time to increase its production, and it will make around 86.19 million euros. And in Q4, let's say it was same as 2019, 120.97 million euros. Now guys, this is a really underestimated revenue. If we compare the revenue which it made in 2020 first quarter, this is really an underestimation. But like I said, always take the numbers considering a worst case scenario, and if your calculations passes the worst case scenario as compared to the current scenario, then that stock is actually a really good buy. So if we take all these numbers, we get a number of 482 million euros. That means if we consider this number plus the Q1 198.2 million euros, we get the total revenue of 2020 as 482 million euros. Now we switch back to the annual financials and we see that the revenue has increased. So from 2017 to 2018, this is a 12% increase in revenue. And even with 12% of increase in revenue, the earnings increased by 90%. Okay. And now from 2018 to 2019, so the revenue increased by 33%. And even with this revenue increase, they made around 99% more in earnings in 2019. So if I say 482 million they make in 2020, that is an increase in revenue by 31%. And you see the history, even if the revenue is increased by 20 to 31%, that means they will surely make earnings of around 90%, because we are assuming that the operational margin will remain about 20% or 25%, because in these 3 years the operational margin was really good. It was around 20 to 25%. That means the operating activities costs will be as same or will be indirectly proportional to the revenue. So that means the revenue is increasing, so operational cost will increase, yes, for sure, but not with a higher margin, the margin will remain the same. Okay, the numbers will increase for sure, but the margins remains the same. So in that case, it means that 90% of increase in earnings will result in an earnings of 95 million euros. Okay, but okay, like I said, let's take the worst case scenario. So let's say that we take the increase in percentage of earnings from 2016 to 2017, which is a really high underestimated increase of earnings if we see the success of Varta with quarter 1 earnings. But anyways, so let's take the worst case scenario. So worst case scenario was that from 2016 to 2017, the earnings increased by just 50%. So even if we take 50% increase in the earnings from 2019 to 2070, it still makes earnings of 75 million euros. Okay, so let's get back to our numbers game. So this is why I really liked this company and thought it of as a good investment. So you see that even with the worst case scenario, which is just 40 to 50% increment in its earnings, it will still be able to make 70 to 75 million euros in 2020. And guys, literally you saw that this is the worst case scenario. And even with this scenario, the reflected earnings which we calculated was around 73 million euros, and the real earnings could be just around this reflected earnings, and I'm pretty sure this Varta would be able to make higher than 73 million euros hands down. And this is how I made my decision to buy this company, and still the purchase price was at 75 euros, and the 52-week high was 128 euros, so it was around at 70% discount. And that's when I really thought that yeah, it has a huge margin to grow when it comes to its stock price, and of course it has a huge margin to grow as well when it comes to its earnings. So despite of the company having a high PE ratio, I still bought this. Yes, you should always compare the PE ratio with its peer or competitors, and in this case the PE ratio for average PE ratio for electrical industry was quite low, and the PE ratio for Varta when the time I bought this was around 65, which is quite high. But this is what I want to tell you, that a high PE ratio doesn't always means that it's a bad buy. Yes, in most of the cases it might be it really might be overvalued, and so in such cases when the PE ratio is out of my comfort zone, especially like in this case, so I do such calculations, and this helps me to actually see that no, the stock is not so overvalued, and even if the PE ratio is high, then it is actually justified. So in this case it is justified, guys. So just with its current assets, it can pay off all its liabilities, all its debts, the long-term or the short-term debts, that doesn't matter, and this is why it is justified. And also the earnings are increasing, so the earnings were almost double, as we saw, 90% to 98% increment, and that's why the PE ratio is quite high, because it's inversely proportional to the earnings of the company. And this also means that the investor actually know that this company is going to make huge profits in the future, so the profit in the future is already baked in to the company's purchase price, and that's why the PE ratio is high. But in this case it is justified, and also it doesn't mean that it is an overvalued company, and I have no problems to hold the stock for a long time. Anyways, I always consider long-term investment as the most effective way of investing.
And I rest my case. Yeah guys, that's it. That's all for today. I really hope that it was easy to understand how I decided and how I chose this stock. So I have put the numbers out there, and I hope this would make easy for you also to make some analysis of your own. And I'm here to help you guys, and if you have any questions or if you have any comments or if you want to say something, just please use the comment section below and I will answer them for sure. Apart from that, if you really liked the video, then please hit that like button. It really helps me. You don't even realize how much it helps me. And don't forget to subscribe and hit that bell icon. I never mentioned this in my previous videos, but yes, because when I will make a new video, you will get a notification, and in that case you will get to see the content which I made, if it's really important or if it's helpful for you guys. So till then, keep investing, stay safe, stay healthy, and peace. Peace and ciao.